It's wild how nobody talks about this. Everyone worships Warren Buffett, quotes his every word, follows his every move. But almost no one's asking why he never talks about these pages. The pages that flipped his thinking at 19. The pages he told his inner circle changed his life, but that he rarely, if ever, discusses publicly. Now, here's the thing. If you've ever felt overwhelmed by investing, or like you're playing a game where the rules keep changing, there's a reason. And it's hidden in the parts of the intelligent investor that most people skip, or never understand. But once you see them, you can't unsee them. By the end of this video, you'll have a lens so sharp, it'll feel like you've been investing blindfolded until now. But there's one principle in particular, buried in just a few paragraphs, that flips everything we were taught about risk, price, and wealth. And we're getting there. But first, if you're here, it's probably because you're tired of the noise. Tired of chasing gains just to end up more confused than before. That's exactly why this channel exists. We're about to hit a huge milestone, and every single subscriber counts. If you believe in clear, no BS financial wisdom that actually helps you build something solid, hit that subscribe button. It's free, and it helps more than you think. Now let's dive in. Jake is 34. Works a decent job, makes around $60K a year, drives a used Honda, no kids, decent apartment outside of Austin. From the outside, he's doing okay. He's read Rich Dad, Poor Dad, watched the YouTube gurus, even bookmarked Warren Buffett quotes on his phone. He's done what they all say, learn about money. But month after month, his bank account stays flat. He's not splurging. He's not reckless. So, what's missing? He thought the problem was tactical. Maybe he just hadn't found the right investment yet, the right ETF, the right strategy. He'd skim pages of financial books looking for formulas. But the breakthroughs never came. Not until he slowed down enough to actually read The Intelligent Investor the way Buffett did. Line by line. Without rushing. That's when something shifted. Not in his portfolio, in his thinking. Jake realized he didn't have a money problem. He had a thinking problem, and the moment it clicked was on a single page, buried in a story about a fictional character named Mr. Market. But hold on to that for a second. Because what Jake hadn't seen yet was the price he'd been paying. Not in dollars, but in years. For years, Jake thought he was investing. In reality, he was just speculating with better packaging. He'd hear a stock tip from a podcast, do a quick search, and convince himself he was making a smart move. But he wasn't studying businesses. He was chasing predictions, hoping the price would go up just because someone smarter sounded confident. That's exactly the trap Benjamin Graham warns about. The difference between investing and speculating isn't in what you buy. It's in why you buy it. Investing is owning a piece of a business you believe will grow over time. Speculating is hoping someone else will pay more than you did, even if you have no idea what the business actually does. And this is where most people get stuck. They confuse noise with knowledge. Back in the 90s, during the dot-com bubble, companies with zero revenue skyrocketed in value, just because they had .com in their name. No product, no customers, just hype. And when the bubble burst, those same stocks crashed by 90% or more. People didn't lose money because they picked the wrong tech. They lost because they weren't investors. They were gamblers who didn't know they were gambling. Jake had fallen into the same mindset. He wasn't looking at earnings reports. He wasn't asking if he'd be comfortable owning the whole company. He was reacting, buying because something was hot, selling because it dipped. All emotion, zero discipline. That's when he underlined a line in the book that changed everything. Graham wrote, "Investment is most intelligent when it is most businesslike." Jake realized he had never run the numbers like a real owner would. But there was still something deeper that hadn't clicked yet. A principle so simple, yet so ignored, it might be the reason most portfolios never survive the first storm. And that's where the metaphor of Mr. Market begins to matter. In one of the most misunderstood sections of The Intelligent Investor, Benjamin Graham introduces a character named Mr. Market. At first glance, it sounds like just another metaphor. But for Jake, this was the page that flipped the switch. Because suddenly, investing wasn't just about numbers. It was about behavior. Human behavior. Graham's Mr. Market is your emotional, unpredictable business partner. Every day, he offers to buy your shares or sell you his at wildly different prices. Some days he's euphoric, offering sky-high valuations. Other days, he's in despair, slashing prices like it's a fire sale. But here's the key. You're never obligated to accept his offer. You can ignore him. You can wait. You can act only when the price makes sense. That's the discipline. Now here's where it gets uncomfortable. In real life, most people treat the stock market exactly like Mr. Market, except they believe him. When prices soar, they think it means success. When prices fall, they panic, as if something fundamental has collapsed. But most of the time, nothing has changed. The business is still the same. It's just Mr. Market having another one of his mood swings. Jake saw himself in that metaphor. He had sold good stocks at losses because the market was down. He had chased hype during peaks. He was dancing to Mr. Market's music, without ever asking who was controlling the volume. But now he had a new lens. The market isn't a guide, it's a tool. It serves you, not the other way around. And this is where the deeper power of that page reveals itself. Because the real edge isn't just seeing Mr. Market's madness, it's knowing when to act and when to wait. And waiting, as Jake would soon learn, only works if you've built a margin for error. We'll get to that. But first, let me show you what happens when you ignore this. Marcos was Jake's college roommate. Same degree, same first job, same income bracket, but a completely different approach. Where Jake had started to slow down, reflect, and study businesses, Marcos went all in on timing. He watched charts, read forums, followed social media hype. In 2021, he was all in on crypto, then tech stocks, then a handful of meme tickers that promised triple-digit returns. For a while, it even looked like it was working. But then came the crash. First crypto, then growth stocks. Prices plummeted. Marcos panicked, sold everything near the bottom, told himself he'd buy back in later. But he didn't. Because the pain of loss sticks. It rewires your risk tolerance. And once burned, most people hesitate indefinitely. As of today, Marcos has less in his portfolio than he did 3 years ago. He still reads financial news, but mostly with a sense of regret. Meanwhile, Jake waited. He watched the same crash unfold, but instead of panic, he saw opportunity. Not because he was fearless, but because he had a plan. He knew which companies were worth owning. He'd already set target prices. And when the market finally threw a tantrum, he acted. Bought strong businesses at steep discounts, held, rebalanced, watched them recover. No tricks, no genius moves, just clarity and discipline. This contrast isn't about intelligence. It's about emotional posture. One acted out of fear, the other out of preparation. And that gap, the space between those who react and those who respond, is where real wealth is built. But none of that is possible without the next principle. A single idea that explains why even the smartest analysis fails when you ignore one basic rule. And it starts with how you build a bridge. Most people think the hardest part of investing is picking the right stock. But what Buffett and Graham understood early on is that the real challenge is not acting when the noise gets loud. Because the temptation isn't just to buy, it's to do something, anything, to feel in control. But control isn't always in movement. Sometimes it's in stillness. Jake learned this the hard way. There were weeks where everything in the market was red. Headlines screaming recession. Analysts revising targets. Friends sending texts. Are you selling too? But Jake had already made his decision, months before the panic. His portfolio wasn't built to impress. It was built to survive. And survival, in investing, often looks boring. This is where Graham's concept of emotional discipline cuts through the fluff. He wrote, "The investor's chief problem, and even his worst enemy, is likely to be himself. Not the market, not the government, not inflation, but his own fear, his own greed, his own impatience." And in that moment, doing nothing isn't a lack of action. It's a conscious decision to protect your future self. Buffett echoed this in one of his most quoted lines. The stock market is designed to transfer money from the impatient to the patient. It sounds simple, but behind it is a brutal truth. Most people won't wait. They'll flinch. They'll exit early. They'll trade discipline for dopamine, and they'll call it strategy. Jake saw that now. Waiting wasn't weakness. It was power. But power only lasts if it's protected. And the final insight that tied it all together wasn't about stocks. It was about identity. Because knowing the game is one thing. Knowing who you are inside it, that's what determines whether you ever really win. Jake eventually stopped chasing predictions. He stopped refreshing stock tickers during lunch breaks. He stopped asking what might go up next. Instead, he asked a different question. Would I still want to own this company if the market shut down for 5 years? If the answer was no, he didn't buy. That became his filter. And filters are freedom. Here's what he built. Simple, boring, and quietly powerful. First, understand the business like you're buying the whole thing. Not just a slice, not just a symbol on a screen. Ask what it earns, how it grows, what its risks are. Second, demand a margin of safety. If it's worth $50, wait until it's trading near $30. Not to be greedy, but to be realistic. Things go wrong. You need room for error. Third, pick a lane. Are you defensive? Content to build wealth through low-cost index funds, rebalancing once a year, trusting compound interest to do its job? Or are you enterprising, ready to put in the hours, analyze reports, find value others miss? Both work. But the middle? That's where portfolios go to die. Fourth, automate what you can. Set up monthly investments. Turn off the noise. Use systems to save yourself from yourself. Fifth, monitor your emotions more than your returns. If you're feeling euphoric, step back. If you're scared, step slower. Investing isn't about feeling good. It's about doing what's right, even when it doesn't feel good. And finally, write it down. Not your goals, your rules. Because when things get loud, you don't need motivation. You need reminders of who you decided to be. Jake didn't become wealthy overnight, but he became unshakable. And sometimes, that's even better. Now there's just one last thing I want to show you. Because the ending of this story isn't about Jake. It's about what you do next. Jake never became a millionaire overnight. He didn't uncover some hidden stock or get lucky during a bull run. He simply stopped reacting and started thinking. He chose clarity over noise, process over impulse. And over time, the results compounded, not just in his bank account, but in his sense of control. That's the part most people miss. Investing isn't just about growing money, it's about reclaiming agency in a world that constantly tries to confuse you. Most investors never fail because of lack of access or opportunity. They fail because they never built a system they could trust when things got hard. The pages Buffett rarely mentions? They were never secrets. They were just too quiet to go viral. They didn't promise overnight success. They promised something better: resilience. And resilience doesn't shout. It stacks, slowly, until one day you look up and realize you're free. So now the question isn't whether you understand the principles. You do. The real question is, what happens tomorrow morning when the market opens, the headlines scream, and your emotions start negotiating with your logic? That's when everything you've learned either becomes action or fades into memory. If this resonated, let it mark a shift. You've stayed through to the end, and that already puts you ahead of most. Maybe now's the time to write your own rule. Maybe now's the time to move with intention. And maybe someone else needs this too. You know who they are. Send it their way before they waste another year listening to Mr. Market.